Hello students, welcome to all of you Shiksha 360, and today basically we will discuss the chapter number 1 part 4, banker customer relationship. This is the last part of the chapter number 1. After that we will start our chapter number 2. So under that we will discuss the deposits products. Clear, what are the different types of the deposits, like time deposits, term deposits, or we can say that like deposits in the current account or in the saving account. Clear, all these things we have to discuss now. So let's start. So deposit products. Now deposit products consist of a wide variety of the financial products. Clear? Deposit products consist of a wide variety of the financial products whereby clients deliver. Clear? Deposits products consist of a wide variety of the financial products whereby clients deliver funds with a financial institution and may a financial return. Clear? And may earn a financial return depending upon the deposit type and duration. Clear? Depending upon the deposit type and duration. Clear? So deposit products basically consist of wide variety of the financial products whereby clients deliver funds with the financial institution. Clear? Whereby clients deliver funds with the financial institution and may earn a clear and may earn a financial return. Clear? And may earn a financial return depending upon the deposit type and duration. So here let us know the different types of the deposit products offered by the bank. Clear? Now we have to understand what are the different types of the deposit products offered by the banks. So first of all, here we have to discuss regarding the demand deposits and the time deposits. Clear? So demand deposits, what are that? That are payable on demand. Clear? So demand deposits are basically those deposits that are payable on demand. Next one, that is what are time deposits? That are repaid. Clear? That are repaid after the expiry of the deposit period. Okay. So demand deposits are those deposits which are payable on the demand, and time deposits basically are those deposits that are repaid after the expiry of the deposit period. Clear? Time deposits are those deposits that are repaid after the expiry of the deposit period. Like we consider it like fixed deposit. Clear? So that are to be repaid to you or paid to you on the maturity. Next one. In the case of the demand deposits, clear? In the case of the demand deposits, there are low interest rates or there is no interest. Clear? So in the case of the demand deposits, either there are low interest rates or there is no interest. Clear? Or there is a no interest. On the other side, in the case of the time deposits, high interest rates. Clear? High interest rates which vary according to the period. Okay. So demand deposits and time deposits. In the case of the demand deposits, basically there is low interest rates or no interest. And in the case of the time deposits, there is high interest rates which vary according to the period. Clear? High interest rates which vary according to the period. Next one, that is it includes. What is to be included? In the case of the demand deposit, it includes current account, saving accounts, overdue deposits. Clear? Sometimes there are those types of the deposits which are not auto renewable. Clear? Which are not auto renewable. Okay, so on the time of the maturity, the interest which is to be paid on the matured amount, it is to be that is of the saving account interest. Clear? And unclaimed deposits. Unclaimed deposits are those deposits in which basically unclaimed deposits are of those accounts in which there is no transaction. Clear? In which there is no transaction in last 10 years. Okay, so kindly remember all these points. Clear? Kindly remember all these points. Next one here, that is in the case of the time deposits. Time deposits are a period ranging from 7 days to 120 months period. Clear? So time deposits are basically for that. It is basically for a period ranging from 7 days to 120 months period with or without reinvestment plans. Clear? So time deposits are basically for a period ranging from 7 days to 120 months period. Clear? 7 days to 120 months period with or without reinvestment plans. Clear? With or without reinvestment plans. Clear? Kindly remember both these points. What are the basic difference between the demand deposit and the time deposit? Now move to the further demand deposit little bit in detail. So demand deposits are classified. Okay. So demand deposits basically are classified into current accounts and the saving accounts. Clear? Demand deposits are classified into the current accounts and the saving accounts. So what are comes under the current account and what is the come under the saving deposit. So current deposits. So the deposits in current account are working funds. Clear, the deposits in the current account are working funds of the business or enterprises. Clear. Clear. So the deposits in the current account are working funds of the business or enterprises and fluctuate widely. Clear, and fluctuate widely and are not paid any interest. Kindly remember that in the case of the current account, clear, in the case of the current deposits or in the case of the current account, there is no interest to be paid. Clear, there is no interest to be paid. On the other side, in the case of the saving deposits, clear, in the case of the saving deposits are to inculcate saving habit and facilitate regular transactions through the banking system and attract interest. So these fluctuate, but not at much, or we can say that less volatile. Clear. So just remember that in the saving account, interest is to be paid. This is the important point. In the saving account, interest is to be paid, and in the current account, no interest is to be paid. This is the important point which we have to remember. Now we can next move towards the time deposits. Clear, time deposits. So time deposit, that is term deposits, are for investing surplus fund for short to long term. Clear. So under the term deposits, basically for what? These are basically for investing surplus funds for short to long term. Clear. Basically for what? For short to long term. So term deposits can have distinguishing feature. Clear. Term deposits can have distinguishing feature for the following parameters. First one, that is mode of interest payment. That is how you will get the, or how you want the interest payment, either on the monthly basis or on the quarterly basis. Clear. Or on the half yearly or yearly basis. Clear. It depends upon case to case. Mode of interest payment, either it is to be periodically or cumulative. Periodically, that is after specific period. Cumulative, that is on the end of the period. In the cumulative, more interest is to be paid. Second one, that is a mode of investment. Clear, how basically you have to invest, either in the lump sum, that is in the case of the fixed deposit, all the lump sum amount is to be invested, and in the case of the recurring deposit, that is to be paid in, invest in the form of the installment. Clear, in the case, or in the form of the installment, that is in the case of the recurring deposit. Third one, mode of return of principal. Clear, third point here which we have to remember, that is mode of return of principal on maturity or in the installment. Clear, mode of return of principal either on maturity or in the installment. Clear. So these are the distinguishing feature of the time deposit. Now next one, time deposits. Clear, term deposits are of several types. Clear, term deposits are of several types as indicated below. Clear, term deposits are of several types basically as indicated below. First one, that is a fixed deposits. Under that first one, that is a fixed deposits, periodically interest payment. Clear. Under that first one, that is the fixed deposits, periodically interest payment. Second one, that is the short term deposits. Short term deposits basically are those deposits having period less than 1 year. Clear. Short term deposits are those deposits having period less than 1 year. Third one, reinvestment deposit scheme. Clear, reinvestment deposit scheme, that is cumulative interest paid on the maturity. Clear, that is whatever the amount along with the principal interest on the maturity, that is to be reinvested. Clear, that is to be reinvested in the same time period. Clear, as per the instructions given by the customer. That is to be known as the reinvestment deposit scheme. Now move to the fourth one, that is the recurring deposit scheme. Recurring deposit scheme, that is you have to pay periodically installments. Clear, that is monthly installments. Last one, that is the flexi recurring deposit. Flexi recurring deposit, that is special type of the recurring deposit in which even if you like every month you are paying your installment, that is 5,000. If you want more, so you can pay more also under that. Clear. So you can pay also more under that. That is to be known as a flexi recurring deposit. Clear. That is to be known as the flexi recurring deposits. Clear. So these are the types of the term deposit. First one, that is the fixed deposits, periodical interest payment. Second one, that is the short term deposit, that is of less than 1 year. Third one, that is the reinvestment deposit scheme. Fourth one, that is the recurring deposit scheme. Fifth one, that is the flexi recurring deposit. Clear. Fifth one here, that is the flexi recurring deposit. Okay, so kindly remember all these deposit schemes. Now move to the next one, hybrid deposits or flexi deposits. Clear. Next point here which we have to discuss, that is the hybrid deposits or the flexi deposits. These are a combination of demand and fixed deposits. Clear. So what are hybrid deposits or flexi deposits? These are a combination of demand and fixed deposits introduced, giving flexibility to the customer. Clear? So what are hybrid deposits or the flexi deposits? These are a combination of demand and fixed deposits. Introduced, giving flexibility to the customer. Clear? Introduced, giving flexibility to the customer. Next, very, very important, that is deposits products for the non-resident Indians. Clear? So what are the services provided to the non-resident Indians? Clear? That is deposit products for the non-resident Indians. So banks also offer special deposit accounts or schemes. Clear? So banks also offer special deposit accounts or schemes for the non-resident Indians or persons of Indian origins and overseas citizens of India. Clear? So banks also offer special deposit accounts or schemes for the non-resident Indians, persons of Indian origin and overseas citizens of India. So what are these? First one, that is NRO account, that is non-resident. NRO, that is non-resident ordinary rupee account. Clear? Non-resident ordinary rupee account. Next one, that is NRE account, that is non-resident external rupee account. Clear? First one, that is O, that is ordinary. E basically stands for the external rupee account. Clear? Non-resident external rupee account. Third one, that is the FCNRB account, that is foreign currency non-resident bank account. Clear? FCNRB account, that is basically foreign currency non-resident bank account. Clear? Foreign currency non-resident bank account. Okay, so kindly remember all these three types of the account. What are the different types of the account they can offer? Okay, now move to the next point. Okay, what are the services to the customers and the investors? Clear? So what are the different types of the services provided by the bank to the customers and the investors? So banks also provide certain other financial services to meet the other needs of the customers and investors. Clear? So these services help in augmenting revenue earning for the banks. Clear? For what? Basically all these services basically helps the bank to earn earning. Clear? For the revenue earnings. Clear? So what are these services? First one, that is the merchant banking. Clear? First one here, that is the merchant banking. What is the meaning of merchant banking? So here, that is merchant bankers are the financial intermediaries. Clear? So merchant bankers are basically whom? Merchant bankers are the financial intermediaries facilitating transfer of capital. Clear? Merchant bankers are the financial intermediaries facilitating transfer of capital from those whose own it. Clear? That is transfer of capital from those who own it, that is who have purchased that, like we consider investor or the bond subscriber, to those who use it. Clear? To those who use it, like basically government issues the bond. Clear? So the government will receive the money and the investor basically will get the bond. Clear? So bank, what is the function of the bank here? Bank will take the money from the investor and will deposit in the account of the government. Clear? So this is the function under that is a merchant bank. Clear? So here merchant bankers are the financial intermediaries facilitating transfer of capital. Clear? What they facilitate? That is facilitating transfer of capital from those who own it to those who use it. Clear? From those who own it to those who use it. Clear? So kindly remember that. Next one, that is they help a corporate in initial public offering, that is in the launching of the IPO or FPO, that is follow up public offer. Clear? Follow up public offer. Clear? So they help a corporate in initial public offering or a follow up public offer, popularly called as a public issue or private placement of debt or equity. Clear? Popularly called as public issue. Clear? Popularly called as a public issue or private placement of debt or equity. Merchant bankers further, that is merchant bankers assist in. Clear? Merchant bankers assist in introducing or selecting. Clear? Merchant bankers assist in introducing or selecting or appointing outside technical consultants. Clear? Merchant bankers assist in introducing or selecting or appointing outside technical consultants in addition to in-house technical personnel, basically for preparation of a detailed project, market survey report, feasibility studies, etc. Clear? Feasibility studies, etc. Clear? So in all these things, basically, generally, basically, just you have to that basically merchant bankers, this help in the launch of the IPO or of the FPO. Clear? Popularly called as a public issue or private placement of debt or equity. Clear? So kindly remember that. Let's other points you can go through. Okay. Not typical. Next one that is very, very important for the examination point of view. What is lease financing? Clear? And this point it is very, very important for the examination point of view. That is regarding the lease financing. Clear? We have to also discuss what are the advantages and the disadvantages of the lease financing. Clear? So this means lease financing basically means that this means leasing out the capital assets. Clear? This what it means, leasing out the capital assets owned by an institution to another company. Clear? This means leasing out the capital assets owned by the institution to another company against payment of monthly rents for assets consumption or use. Clear? Against payment of monthly rents for asset consumption or uses. Like we can say that, like you will see that basically in the news many times, that is BSNL has big offices. Clear? Like BSNL has big infrastructure. So they will lease their, like we can say that one or two buildings. Clear? If there is a 3-floor building, so one or two floors to the other companies, just for the understanding purpose. Clear? This is the capital asset of the BSNL. Clear? That is their building. Clear? So for what basically they will get the monthly income in the form of the rent here. So here the finance. Clear? So here the finance is provided by the institution. Clear? Here the finance. Similarly, this type of thing is to be done by the bank also. Clear? So here the finance is provided by the institution, maybe a bank too, called lessor. Clear? Called lessor, which does not enjoy the use of the asset but is its owner. Clear? Which does not enjoy the use of the asset but is its owner. So here the lessor is entitled. Clear? So here what is that is, the lessor is entitled to write off a certain amount of capital cost. Clear? So in this case, the lessor is entitled to write off a certain amount of capital cost, that is in the form of the depreciation charge on the capital asset against its taxable profits until it is fully written off. Clear? Against its taxable profits until it is fully written off. Clear? So here that is what they're saying, that the lessor is entitled to write off a certain amount of capital cost. Clear? So under that, the lessor is entitled to write off a certain amount of the capital cost against its taxable profits. Clear? Against its taxable profits unless it is fully written off. Clear? Unless it is fully written off. On the other side, while the lessee is benefited. Clear? While the lessee is benefited by not investing funds in the capital cost. Clear? While the lessee is benefited by not investing funds in the capital cost, because the lease charges are permitted to account as revenue expenses in its books of accounts. Clear? Lessee, that is who is taking the building. Clear? Who is taking the building or who is using the asset for its work. Clear? So while the lessee, that is benefited by not investing funds. Clear? So they will get the benefit also, that is by not investing funds in the capital cost. Clear? In the basically we can say that in the building and the lease charges. Clear? Which they are paying on the monthly basis. Clear? The lease charges permitted to account as revenue expenses. Clear? So they will debit it in their accounts as the revenue expenses in its books of account. Clear? Revenue expenses in its books of account. Further, the lease can also be arranged. Clear? The further, that is the lease can also be arranged on any existing freehold asset. Clear? The lease can also be arranged on any existing freehold asset or long leasehold property. Clear? So the lease can also be arranged on any existing freehold asset or long leasehold property. Clear? Or long leasehold property by either mortgaging it. Clear? By either mortgaging it, that is by either mortgaging the property or by selling it at a market price to a leasing company. Clear? Or by selling it to a market price at a leasing company. So this leasing company in turn would lease it back to the seller of the asset on lease, thus be benefiting both the entities. Clear? So thus benefiting both the entities. Clear? So in a lease, the lessee of the equipment does not become the owner thereof. Clear? So the person who will take the any asset on the lease, it will not like this like that person will become the owner. Clear? It is will not like that. Clear? So they have taken the building or the capital asset only on the lease for the purpose of the work. Okay. So kindly hope all of you are able to understand the lease financing. That is just simple remembering this line. Clear? So this means that is leasing out of the capital assets owned by an institution. Clear? That is to be owned by an institution basically to the another company against payment of monthly rents. Clear? Forward, that is against payment of our monthly rent for the asset consumption or use. Clear? Against payment of monthly rents for the asset consumption or use. Now, next one, that is what are the advantages and the disadvantages. Clear? So first of all, we have to discuss what are the advantages to the lessee. Use of asset, that is basically who is taking the building on rent. just for the understanding purpose. Use of asset without incurring the capital cost. Clear? Use of asset without incurring or without spending the capital cost, thus saving the cost on capital. Clear? So thus saving the cost on capital. Next one. Lease rentals. Clear? Lease rentals are business revenue expenses. Clear? Lease rentals, basically what are that? That is basically our business revenue expenses. So what it does, basically it helps us to reducing the taxation and contracting profits. Clear? That is contracting profits and reduces the taxation. So third one, since there is no capital cost. Clear? So since there is no capital cost, so this does not impact the liability side of the balance sheet. Clear? So since there is no capital cost under that, so this does not impact the liability side of the balance sheet. Clear? Liability side of the balance sheet. Fourth one, credit worthiness of the lessee is maintained at a higher level, facilitating it to the borrower further. Clear? Borrow further. Clear? Credit worthiness of the lessee is maintained at a higher level, facilitating it to the borrow further. Clear? So these are some of the advantages of to the lessee. Clear? Hope all of you are able to understand. Very simple words and very simple things they are mentioning here. Next one, that is the disadvantages. Clear? So what are the disadvantages to the lessee? That is ownership of the asset. Clear? Even after paying the rent, they will not get the owner. Clear? Ownership of that building. Clear? So ownership of the asset is held with the lessor and not with the lessee. Clear? Ownership of the asset basically is held with the lessor and not with the lessee. Second one, the asset is permitted. Second one, that is the asset is permitted to be used. Clear? The asset is permitted to be used for agreed business purposes only. Like for what purpose you have taken the building, you have to use only for that purpose. Clear? So the asset is permitted to be used for the agreed business purposes only, preventing from utilizing the asset for alternative business purposes, if any. Clear? So here the asset is permitted to be used for the agreed business purposes only, preventing from utilizing the asset for alternate business purposes, if there is any. Next one, that is if they will breach the conditions. Clear? Confiscation or repossession of the asset. Clear? That is they will take back their building or asset. Clear? Confiscation or repossession of the asset by the lessor on breach of the terms and conditions. Clear? Confiscation or repossession. Confiscation or repossession of the asset by the lessor. Clear? By the lessor on the breach of the terms and conditions. Clear? On the breach of the terms and conditions. Fourth one, if the lessor or owner. Clear? If the lessor or owner becomes insolvent. Clear? If the lessor or owner becomes insolvent or goes into liquidation. Clear? If the lessor or owner becomes insolvent or goes into liquidation, the asset may be attached by the liquidator. Clear? So in that case, the asset may be attached by the liquidator. Clear? So these are some of the disadvantages. Clear? If the lessor or owner becomes insolvent or goes into the liquidation, so then the asset may be attached by the liquidator. So hope all of the points regarding that lease financing, it is clear to all of you. And here that we will discuss regarding the advantages and the disadvantages to the lessee also. Clear? These are the important points under the chapter number 1. Clear? So it leads to the completion of the topic. And one or two more points left. That is what are plastic money, charge cards, credit cards, debit cards, ATM cards, prepaid cards, co-branded cards. Clear? These we will discuss in another topic. Clear? This we will discuss in the another topic. There is nothing any typical under that. Just you can go through. I will discuss in detail in another chapter. Okay. So thanks to all of you for joining this session. This leads to the completion of the chapter 1. And after that, I will upload the questions in the group. So you can go through that. Slides are already uploaded in the group. So thanks to all of you for joining this session. In the next, we will start the chapter number 2.